Welcome students to Module 8. In Module 5, we examined the nature of risk in finance and saw that we could use asset pricing models like CAPM to calculate the required return for an asset or security based on its level of risk. This required rate of return can be used as a discount rate in the valuation of projects or in the valuation of firms. However, we use CAPM as a discount rate only if the project or the firm is financed with equity only. CAPM gives us the required return on equity, the cost of equity. What happens if the firm has debt as well? In reality, all firms employ both debt and equity, and most employ several different types of equity and a number of different types of debt. The discount rate that we use then must take in consideration that the capital of the firm consists both of equity and debt, so that we incorporate not only the risk of equity but also the risk of debt. This is what are we going to talk about in this module: how to calculate the cost of capital using the weighted average cost of the various types of equity and debt the firm uses. First, we revise some concepts that we learned in previous modules in terms of cost of equity, debt, and preferred stock. Then we put them all together in the cost of capital. We then discuss some issues surrounding the applicability of cost of capital to evaluating projects. In the second part of the module, we take a closer look at project evaluation, in particular, how to address the risk in capital budgeting, and what methods and techniques managers employ to account for these things like scenario sensitivity and simulation analysis and real options. Theory would say that discounted cash flow techniques, DCF techniques like NPV, IRR, and PI, are the most appropriate for evaluating projects. As we've seen, these methods cannot be used if we don't have a discount rate. Thus, choosing a suitable rate is crucial in the process, and it affects the decision about the project, whether to reject it or accept it. A survey of how companies in Australia use valuation methods for projects has found that the discount rates used by managers are similar to those recommended by the corporate finance texts. In the conclusion, the authors note that the cash flows for the project are discounted using a rate called the weighted average cost of capital, or WACC, sometimes just referred as the cost of capital, which includes the cost of equity preference shares and the cost of debt for the firm on top of the cost of ordinary equity. And that the CAPM remains the leading asset pricing model used for calculating the costs of equity in practice, despite academic criticism and the development of alternative multi-factor asset pricing model. So why do we need a cost of capital? Why is it so important? Remember, the assets of a company are financed by investors who either buy shares or equity in the company, or either lend money or buy bonds or debt. In the first modules, we saw that the cash flow from assets, whatever the company makes, is distributed to the cash flow to shareholders and cash flow to creditors. The cash is returned to investors, whether they are equity holders or bond holders. So whatever the company pays, the investors receive. Therefore, the return to the investor is the same as the cost to the company. We call this cost the cost of capital because equity and debt provided the capital for our company to buy all the assets, to finance our investments and projects. This cost of capital is very important because it tells us how the market views the risk of our assets or our projects. Thus, it is this cost of capital that we use in our capital budgeting techniques. firm cannot make any capital budgeting decisions unless they have first the required rate of return, because NPV calculation is not possible without that discount rate. The IRR must be compared with the hurdle rate or the required rate of return. So the required return is the same as the cost of capital. One is from the investor's point of view, the other is from the firm's point of view. Because the firm is financed by both debt and equity, the cost of capital is a mixture of the cost of equity and its cost of debt, costs that are determined by the market. What the firm can determine is how much should be debt and how much it should be equity. In other words, the firm sets up the preferred debt-to-equity ratio based on a firm's target capital structure. Why do we say target capital structure? Because the management establishes only the proportion of debt and equity, a target structure, a desirable proportion of debt and equity. But the market movements causes the value of debt and the value of equity to change. Therefore, the debt-to-equity ratio can change away from this target depending on the market movements. So to calculate the cost of capital, first we need to calculate the cost of equity, then cost of debt, their proportions in the overall capital, and then combine them. We start with the cost of equity, and in Module 5, we saw how we can use the model to calculate the expected or required rate of return for shares. The CAPM is a general asset pricing model, so technically it applies not just to equity but all forms of capital, including human capital. From the formula, we see that managers must estimate all these inputs. Risk-free rate can be easily accessed from the RBA side. The market risk premium, the premium expected for investing in risky assets over the riskless asset, can be accessed from market research reports or can be calculated using historical market data and the risk-free rate historical returns. And the asset beta, or the risk of the asset, which has to be calculated using historical returns. Although CAPM is the most commonly accepted way of finding the cost of equity, it has the disadvantage that it uses past returns to estimate beta and market premium. Past data is not always an indication of what's going to happen in the future. Also, the risk inherent in those past returns might not be relevant for the future. As we know, return volatility varies over time. These are the factors influencing a company's beta. First of all, it depends on the type of business the company is in, whether it's the airline business, car manufacturing business, pharmaceutical business, and so forth. We call this business risk, and in turn, this is influenced by industry effects. The beta for a firm depends on the sensitivity of the demand for its products and services and of its cost to macroeconomic factors like interest rate changes and inflation. Cyclical companies, firms which sell more discretionary products like food and essential products like soap, tend to have higher betas, while non-cyclical firms like utilities, gas, electricity, water tend to have low betas. Another factor affecting beta is the operating leverage, which refers to the degree to which a firm relies on fixed costs, or the proportion of the total costs of the firm that are fixed. The reason is that fixed costs act like a lever by magnifying the changes in the cash flows or earnings as a result of changes in sales. Other things remaining equal, high operating leverage results in greater earnings and cash flow variability, which in turn results in higher betas. And this usually applies in capital-intensive industries which tend to have higher betas. The second type of risk is financial risk, also known as leverage. Leverage is the extent to which a firm finances its operation by borrowing. As firms borrow more, they create fixed costs, interest payments, that make their earnings to equity investors more volatile, which in turn increases the equity beta. We will learn more about the impact of financial leverage on beta in Module 9. Operating and financial leverage are similar in that they infer a high proportion of fixed costs relative to variable costs. Regardless of the level of output or revenue, these fixed costs remain. This is of benefit when output increases, as these costs are spread over larger amounts of output. This levers earnings up. However, when output decreases, the fixed costs remain, and this serves to lever or push the EBIT down. This is a reminder on how to calculate cost of equity. So we have this company, Austral Carbon Light, AC, an all-equity company, which is evaluating a proposal to build a new manufacturing facility. The company manufactures bicycle frames. As a luxury good producer, the firm is very sensitive to the economy, so we can say the product demand is elastic. The Carbon Light shares have a beta of 1.5, and they know that the risk-free rate is 5%. And also they expected the market return to be 11%. We apply the capital asset pricing model, and we find that the resulting cost of equity is also high relative to the market, because our beta is higher than the beta of the market. Remember a positive relationship between beta and returns. So again, even before we do the calculation, we know the result we'd have to be greater than 11% because the firm's beta is 1.5. So the company must make at least 14% on the capital invested by the shareholders to compensate them for their money. Anything less means loss of shareholders' value. Sometimes companies issue preference shares to raise capital. It is still equity, and we must include it in the cost of capital. However, remember, preference shares are a different form of equity because it pays the same dividend forever. These features are characteristics of a perpetuity, and we know that the value of the perpetuity using a simple formula is found as the dividend divided by the rate of return. So we take the perpetuity formula, rearrange it, and solve for RP, the required rate of return for preferred shareholder. For example, if a company pays a dividend of $3 and the current price is $25, the rate of return is just the dividend divided by the price. In other words, the dividend yield. Debt for the purpose of calculating the cost of equity generally has the following characteristics. There is a commitment to make fixed payments in the future. The payments are tax deductible, and the failure to make the payments can lead to either default or insolvency or bankruptcy. Therefore, debt includes any interest-bearing liability, whether short or long-term, and any lease obligations, whether operating or capital. How do we calculate cost of debt? If the firm has bonds outstanding and the bonds are traded, the yield to maturity on a long-term straight bond can be used as the interest rate. If the firm is rated, we use the rating and a typical default spread on bonds with that rating to estimate the cost of debt. If the firm is not rated and it has recently borrowed long-term from the bank, use the interest rate on that borrowing. For example, if this company issued a 20-year 12% bond 10 years ago and that bond's current market value is $86, and if the coupon payments are annual payments, what is the cost of debt? What kind of bond is this? This is a discount bond because it has a price of $86. It's less than the par value. So because it's a discount bond, we know that the yield, or RD, should be higher than the coupon rate. In Excel, we use the rate formula to solve for RD to be 14.76%. Note that we don't use 20 years as our number of periods, we use the remaining 10 years because the bond price is based on the remaining years to maturity. These are some current data on Australian debt. On average, small businesses pay just above 6% on their borrowing, while large businesses over 4%. On the right side of the slide, we have the average variable rate, the black line, while the bottom graph represents the trend of the fixed interest rate. The swap rate, which is the fixed interest rate you get if you decide to swap from the variable rate. In the Australian bond yields graph, we observe that the government bond, since it's the safest, has the lowest yield. The lower the credit rating gets, the higher the yield becomes. Swap is the rate again if you get to swap a non-treasury bond for a 3-year government bond. Now that we know all the costs for each type of finance in the firm, we can calculate the overall cost of capital, which is the weighted average of all the individual costs. This weighted average cost of capital, or WACC, reflects on average the firm's cost of long-term financing and is the required return on the firm's asset based on the market's perception of the risk of those assets. Note the 3 versions of the formula. However, you should get the same result using either of them. But before we go on and calculate the WACC, we must find the proportions of each cost in the overall financing of the firm, which are based on the market values of each type of finance. And the market values of each type of finance is just the number of each type of outstanding security out there in the market multiplied by the price of that security. The total market value of the firm is the sum of the market values of all forms of capital. And based on the individual market values and the total value of the firm, we can find the weights or the percentages of how much equity is in the firm, how much debt is in the firm, and so forth. Note that the sum of the weights must always equal 1, or 100%. For example, Smith & Jones has 1 million ordinary shares that trade for $50 a share. The shareholders require a return of 15%. The company also has 200,000 preference shares that pay 8% dividend, which sell for $80 a share and require a return of 10%. Their debt is in the form of 47.1 million par value, 5-year maturity fixed rate notes with 8% coupon rate and 7% yield to maturity, which sell at a premium for $49 million. Out of this information, we write down the costs of each type of capital, and then we calculate each of their market values. Note that for debt, we are already given the market value at $49 million. Then we calculate the total value of the firm, upon which we calculate each type of financing proportion. Then we apply the weighted average cost of capital formula, and we find that the overall cost of capital for the firm is 10.9%. We have thus far assumed away taxes, which are often important in financing decisions. Managers are concerned with after-tax costs, so we need to consider the effect of taxes on the various costs of capital. As the company gets a tax deduction only for the interest on its debt, this interest expense reduces our tax liability. This reduction in taxes reduces our cost of debt. The after-tax cost of debt becomes RD multiplied by 1 minus TC, where TC stands for the corporate tax rate. Remember, dividends are not tax deductible, so there is no tax impact on the cost of equity. Same with preference share. So the WACC adjusted becomes the same formula, except we make that change on RD. We multiplied RD by 1 minus TC. Looking at our previous example and applying the tax rate of 30%, the after-tax cost of debt is 4.9%, and thus the adjusted WACC becomes 10%, a reduction of 0.9% from the previous slide. Accounting for taxes doesn't change the rules for selecting the discount rate, but it does make that cheaper. We move on now to discuss when it is appropriate to use WACC as our discount rate. The WACC for a firm reflects the risk and the target capital structure used to finance the firm's existing assets. WACC is the appropriate discount rate in an NPV only when the proposed investment is similar in risk to the firm's existing activities. If the new projects have different risks, we must determine the appropriate WACC that reflects that particular risk for that particular project in order to make the appropriate decision. Sometimes big firms have many divisions that are totally unrelated to each other. In that case, we must calculate the WACC for each division to evaluate projects in those respective divisions. For example, if we look at the General Electric company, we can see that it has many business divisions, and within those divisions different branches as well. It would be inappropriate that projects proposed by the healthcare group should have the same discount rate as projects proposed by the aviation services. If GE's overall WACC was used for every decision, it will lead to poor investment decisions, poor capital budgeting decisions. A riskier division would get more investment capital because those projects' IRR will always be greater than the WACC. We would accept them all the time. On the other hand, a less risky divisions would lose the opportunity to invest in positive NPV projects because those projects' IRRs will always be less than WACC, less than the hurdle rate, and would reject them all the time. For example, we have 3 projects with different risks from the firm that have the following required returns and IRRs. If we disregard the fact that they have different risks and use the same WACC for all our projects as our hurdle rate and compare it with the IRR, we would take project A and project B because their IRR is greater than 15 and reject project C as its IRR, the 12%, is less than 15%. So we look at the red colored words, accept A and B and reject project C. This would be an incorrect decision because WACC does not reflect the risk of that specific project. Now, if the evaluation of the project using the required rate of return based on the risk of the project, we would accept project B and C as their IRR are greater than the hurdle rates and reject project A because the IRR 17 is less than 20%, the required return, the hurdle rate. So you look here at the table at the blue highlighted words, reject A and accept B and C. So what happened when we used the WACC? We accepted a risky project that we shouldn't have, project A, and rejected a less risky project that we should have accepted, project C. What will happen to the overall risk of the firm if the company does this on a consistent basis? The firm will become riskier because we accept riskier projects by mistake. As a result, the firm's cost of capital will increase as well, adjusting for changes in market returns in general. These are some of the ways managers use to calculate the cost of capital based on different circumstances. The divisional approach requires a separate WACC for each division that has different risk levels. If we decide to use the pure play approach, we must calculate a discount rate that is unique to that particular new project with different risk from our line of business. What we do is look at our other companies in the same line of business as the new project and calculate an average WACC based on each company's WACC. Then we use this average as our discount rate for the project that we investigate. If using the subjective approach, we compare the risk of the project with the risk of the overall firm, and if we think the project has more risk than the firm, we take a higher discount rate than the WACC. And if we think the project has lower risk than the risk of the firm, we use a lower discount rate than the existing WACC. So it's a very subjective method.